6%, gone, in hours. While you went about your day, silver touched $120 an ounce, then collapsed in one of the most violent reversals this market has seen in 40 years. And right now, Wall Street professionals are using a single word that should stop every investor cold: broken. Not volatile, not correcting, broken. If you own silver, if you are thinking about buying silver, or if you simply want to understand what is happening in one of the wildest markets in modern history, everything I am about to show you could fundamentally change how you think about precious metals and your financial future. Let me walk you through exactly what happened on January 29, 2026. Silver futures pushed toward $120. Pause on that number for a moment. Just 12 months ago, this same metal traded below $31. Do the math. 274%. In 1 year. Not tech stocks, not crypto, silver. A metal humans have valued for 5,000 years, suddenly moving like a meme stock. Then the reversal hits. Sellers emerge. What begins as profit-taking turns into something worse. Within hours, silver crashes more than 6%. Traders who bought the highs watching positions evaporate in real time. Gains that took weeks to build disappearing in minutes. And here is what should genuinely concern you. This was not an isolated event. Just days earlier, silver crashed 13% in 4 hours, from $117 to $102. Then it recovered. Then it dropped again. The kind of volatility that wipes out trading accounts, triggers margin calls, and forces people out of positions they intended to hold for years. Nikki Shields is one of the most respected analysts in the precious metals industry. She runs research at MKS PAMP for institutional clients managing billions of dollars. When she looked at what silver is doing this week, she used one word to describe it: broken. Unheard of volatility. A market structure that no longer functions the way markets are supposed to function. That assessment came from someone whose entire career is built on understanding these markets. Now hold that thought. Because while silver was crashing, something else was unfolding thousands of miles away that makes this situation even more dangerous. Tehran broadcast a warning over maritime radio channels. Live fire naval exercises commencing in the Strait of Hormuz. If you have never thought about the Strait of Hormuz, you should start now. 20% of all the oil consumed on this planet flows through that narrow waterway every single day. Disrupt that flow, and every market on Earth feels it within hours. An Iranian Revolutionary Guard commander made a statement, "I need you to hear word for word. Iran has complete control of the Strait of Hormuz. If war breaks out, there will be no retreat, not even by a millimeter." Those are his exact words. Direct, unambiguous, the kind of rhetoric that moves global markets. Now connect these dots with me. Safe haven assets exist for moments exactly like this. When geopolitical uncertainty spikes, when headlines turn dark, when military exercises happen in critical shipping lanes, capital does not sit still. It moves. It searches for safety. And one of its primary destinations has always been precious metals. Silver is unique among safe haven assets. It combines monetary appeal with industrial necessity in a way no other metal does. Solar panels require silver. Every single one. There is no substitute that works as well at scale. Electric vehicles require silver. Charging infrastructure requires silver. Defense systems require silver. The semiconductor industry that powers everything from your phone to artificial intelligence requires silver. And here is where the situation becomes even more serious. January 1st, 2026. China changes everything. New export restrictions take effect. Only 44 companies now authorized to ship silver out of the country. Before this policy, hundreds of exporters participated freely in global markets. China refines 60 to 70% of all the silver on this planet. With one policy change, they have become the gatekeeper of global supply at the exact moment demand has never been higher. Think about what that means. The largest producer of refined silver just decided to restrict access. Western industries dependent on Chinese silver now face higher costs and genuine supply uncertainty. Mining new silver takes a decade from discovery to production. Recycling provides only about 20% of annual supply. There is no quick fix. There is no alternative source waiting in the wings. The supply squeeze is real, and it is here now. Let me give you a number that shows just how abnormal this market has become. January 26th, the iShares Silver Trust, the biggest silver ETF on Earth, saw $40 billion in trading volume in one day. $40 billion. Do you know what else trades $40 billion in a day? the SPY, the ETF that tracks the 500 largest companies in America. Apple, Microsoft, Amazon, Nvidia, Google, all of them combined. Silver matched that volume. In a single session, one metal generating as much trading activity as the entire large-cap U.S. stock market. That is not normal. That is not healthy price discovery. That is what happens when speculation overwhelms fundamentals and a market loses its anchor to reality. Maximilian Thomé manages money at Galena Asset Management. He has spent his career studying commodity markets. His assessment of silver should make you think twice before placing any trade. Fundamentals do not explain a commodity increasing 200%. The way silver is behaving is exaggerated. A series of disconnects from reality. The market is broken. Why is this happening? Where is all this capital coming from? Here is the explanation you will not hear on financial television. Government bonds used to be the destination when uncertainty spiked. Safe, stable, predictable, but sovereign debt burdens have exploded globally. The United States alone carries more than $36 trillion in national debt. Confidence in government credit has eroded. Bonds no longer feel safe to many institutional investors. Stocks have rallied for years. Valuations look stretched. The easy gains feel increasingly behind us. And when investors start searching for diversification, for assets that move differently from equities, precious metals become attractive. Silver is a relatively small market compared to gold or stocks. When even modest capital flows shift towards silver, prices move dramatically. This is exactly what we are witnessing. Liquidity searching for a home, finding silver, and pushing prices far beyond what supply and demand alone would justify. This creates a dangerous dynamic. The same flows driving prices higher can reverse just as quickly. When speculators decide to take profits, when margin calls hit over-leveraged traders, when sentiment shifts on a single headline, the exit can be as violent as the entry. We just witnessed that. 6% evaporating in hours. History has something important to teach anyone watching silver right now. 1980. The Hunt brothers, two Texas billionaires who believed they had discovered a sure thing in silver. They accumulated massive positions, driving prices from $6 to nearly $50 an ounce. Everyone watching thought they had found the secret to unlimited wealth. Silver only goes up, buy more, hold forever. Then it ended. The COMEX changed margin requirements overnight. Traders who could not meet the new requirements faced forced liquidation. Selling triggered more selling. Panic cascaded through the entire market. Within 2 years, silver lost 90% of its value. Fortunes built over years evaporated in weeks. Some investors never recovered. The CME has already raised margin requirements on silver futures this year. This is not speculation about what might happen. It has already happened. Traders without sufficient capital have already been forced out of positions. The same mechanism that destroyed the Hunt brothers is active right now. But here is where today differs from 1980 in ways that matter. Back then, silver was primarily a monetary curiosity, a speculation, an inflation hedge with limited industrial use. Today, silver is critical infrastructure for the 21st century economy. The energy transition cannot happen without silver. Solar manufacturing alone consumes more than 25% of global annual production. Every panel needs silver. There is no alternative at scale that matches its conductivity and reliability. Electric vehicles use substantially more silver than traditional cars. Charging systems depend on it. Power electronics require it. Defense applications, while secretive about exact quantities, consume significant amounts. Artificial intelligence data centers running the systems transforming every industry require silver in countless components. The modern economy runs on silver in ways the 1980 economy simply did not. This structural demand is not going away. The world is not going to stop building solar panels because silver reached triple digits. Governments have committed to clean energy transitions. Corporations have made net zero pledges. Industrial silver demand is locked in for decades regardless of price. This creates genuine tension at the heart of this market. Supply that cannot grow quickly confronting demand that will not disappear. Bulls look at this and see prices going much higher. The fundamental case is genuinely strong. Bears look at history. Every commodity mania ends. Prices rise until they become uneconomical for industrial users. Substitution begins. Demand destruction kicks in. The rally loses momentum and reverses. This is already happening. Major Chinese solar manufacturers have begun replacing silver with copper and aluminum where technically possible. When silver becomes expensive enough, Engineers find workarounds, not everywhere, not perfectly, but enough to slow demand growth and eventually bend the price curve back down. The Federal Reserve threw another variable into this equation just days ago. Interest rates held steady, inflation remains sticky, economic growth resilient enough that rate cuts are not imminent, the path forward uncertain. Uncertainty about monetary policy historically benefits hard assets. Gold rises, silver rises. Assets that central banks cannot print gain appeal when confidence in paper currencies wavers. The dollar has dropped nearly 11% over the past 12 months. When currency weakens, commodities priced in dollars rise in nominal terms, even when underlying fundamentals stay unchanged. The falling dollar has been powerful tailwind for silver. If the dollar reverses and strengthens, silver faces an equally powerful headwind. Every geopolitical headline creates risk in both directions now. If Iran actually disrupts shipping through the Strait of Hormuz, safe haven demand could send silver higher regardless of current valuations. If tensions ease tomorrow, the safe haven bid evaporates and profit-taking accelerates. If the Federal Reserve surprises with rate cuts, silver benefits. If they unexpectedly raise rates, silver suffers. If China loosens export restrictions, supply pressure eases. If they tighten further, prices have room to run. Nobody can predict which scenario unfolds. Anyone claiming certainty is either misleading you or trying to sell you something. What happens next depends on variables that are genuinely unknowable right now. Chinese policy decisions made in Beijing behind closed doors. Federal Reserve decisions made in Washington based on data we have not seen yet. Geopolitical developments in the Middle East, driven by actors with their own agendas and timelines. Industrial demand trends shaped by engineers responding to price signals. Speculative flows driven by sentiment that can change by the hour. All of these factors moving simultaneously. All capable of moving silver 20% in either direction with almost no warning. Position sizing matters more right now than at any point in recent memory. Whatever exposure you have to precious metals, this is not the environment to concentrate your bets. The professionals describing this market as broken are not being dramatic for attention. They are describing what they observe every day. Markets where price moves have disconnected from fundamentals. Markets where volatility exceeds anything they have witnessed in their careers. Capital preservation deserves serious focus when conditions are this uncertain. Having cash available if price is correct significantly creates options that fully invested portfolios do not have. Smaller position sizes reduce damage from the drawdowns that inevitably occur in volatile markets. These are not exciting strategies. They will not make you rich overnight, but they might keep you in the game long enough to participate in whatever comes next rather than being forced out at the worst possible moment by a margin call or emotional panic. The easy money has been made. Buying silver at $30 and holding to $115 required no special insight, just patience and willingness to endure volatility along the way. What comes next at these levels requires something different: awareness of risk, respect for a market that seasoned professionals are calling broken, understanding that speculation can drive prices far beyond what fundamentals justify, and that corrections from speculative excess are historically brutal. Today, silver sent a clear message: 6% crash after touching all-time highs. Industry professionals using words like broken to describe market structure. Geopolitical risks escalating with live-fire military exercises in one of the most critical shipping lanes on Earth. China restricting exports of a metal the world desperately needs. These are signals, clear ones. Whether they signal opportunity or danger depends entirely on how you are positioned and whether you are prepared for whatever comes next. Because the next chapter in silver is being written right now, this week, today, and based on everything unfolding, it may be the most consequential chapter in this metal's modern history. Pay attention. Adjust accordingly. Because markets this volatile do not give second chances.